Hi everyone, time really fly. It's time for us to look at the fourth quarter. And we have separated this video into 6 parts. Firstly, we will see what we have said in the third quarter review. Then we will take a look at the common investors' concerns. Then we will see equity performance year to date. And then we will take a look at the US interest rate outlook. After that, we will see the impact of extreme weather globally. What's the implication and the impact? Last but not the least, we will see our take for the fourth quarter of 2023. Let's see what we have said in the third quarter. We said individual investor could take an easy approach as the return on time deposits is already 4 to 5% per annum. Amid all these global uncertainties, it is a very reasonable return. And we see the risk markets, such as the equity markets, generally supported by the positive and rising interest rate. Nevertheless, sector and stock selection becoming even more difficult. We always prefer owning ETF as the main vehicle of owning risk assets. So far, we are correct. Let's see the common investors' concerns. Investors generally have some concerns towards the global financial markets. Monetary policy, ECB, encourage interest rate to stay at a 5-year high despite weaker expected economic growth. Expect US need to keep their high interest rate for quite a while, so everyone in the developed market is still haunted by the tightening. Geopolitical events, China, US, and the Allies confrontation, we expect it will remain. Russia-Ukraine war probably will stay for a while. Direct investment flow generally will be guided by this political stance. High-risk event, we see global financial watchdogs always warns about there are future challenges and shocks ahead because of longer and higher interest rate plus property down cycle. So actually this is the concerns. We also see corporate earnings, although it's a mixed bag of results. And we see US and Europe stock market so far enjoyed double-digit gains year to date. It looks okay. It's just a mixed picture. We see investor sentiments, as we said, is directed by political sentiments quite a lot. So far, investors have adapted well to these uncertainties. Liquidity switched back to US and its allies market so far. We see reasonable gains on the equity market, except Hong Kong, China. And the high-risk event, again, we talk about the US debt ceiling has been raised and who will buy the new US debt. And we see data are pointing to US allies and the domestic US investors are buying their own debt. Extreme weather and the domestic property down cycle pose real risk to the companies and investors in the developed markets under high interest rate. We'll talk more about it in the coming slides. Let's see the equity performance year to date. Let's see how the US equity market has performed. We have found out some data about the long-term performance, 20 years performance for the S&P 500. So far this year, it returned 20% year to date. And for the last 20 years, S&P 500 annualized return around 10%. So very decent and reasonable return for investors. Yet the downside, maximum drawdown, annualized terms are over 50%. So reasonable return in the long run, but when something hit, it can drop very fast and hard. But so far so good this year. 20% as pointed year to date, and annualized return around 10% for the last 20 years. And the maximum drawdown over 50% when something happened to the stock market. So how about Asia equities? Year to date, as of end of August, generally Asia stock markets have registered positive gains except Hong Kong and China, with Hong Kong the worst performer year to date. Sector-wise, IT, industrial are registering about 10% gain. For Japan, Korea, Taiwan markets, they perform positively with high double-digit returns, which is very reasonable and not bad performance so far. And one thing I want to highlight is India. It is a dark horse. When we compare the 5 years performance number in Asia, quite a drastic return contrast with Hong Kong stock market. So in the past 5 years, Hong Kong stock market is the worst performing stock market among US, China, and India. And we can see the number. Hang Seng Index dropped about 32%, while India market up 74% with local currency. So roughly, we can see the performance difference is 100%. That means India outperformed Hong Kong in the last 5 years by over 100%, which is quite impressive. And we'll still see a lot of opportunities for India during these political uncertainties, especially when China, US still have political conflicts. US interest rate outlook versus China's US debt reduction. Interesting. The implication of foreign ownership of US debt, which is always a discussion topic for global investors. We have found out over 50% of US foreign debt were owned by 5 countries, as shown in the chart. Japan, China, UK, Belgium, Luxembourg. China and Japan actually have reduced their holding of US debt compared with the peak level. And we see the ownership are increased from the European countries, UK, Belgium, and Luxembourg. China has reduced around 30% of its US debt holding, around 250 billion, compared to its peak level. As of August 2023, China now owns around 859 billion US dollar worth of US dollar debt. And when compared with US 200 billion on January 2003. In view of the existing and we projecting the political interactions among US and China, we see continual reduction of US debt may become a discipline for Chinese economic management. So you can see 200 billion reduction from the peak, and we expect the debt reduction program may continue over coming years. China is reducing the lending to US. It makes sense for everyone, as there is no point to lend money to one's competitor that is using the borrowed money to block one's way to success. Is it a loss-making trade while selling US dollar bond in a rising US interest rate environment amid a weaker Chinese yuan? Let's see some simple numbers. We use a rough estimation using the data available at the end of September 2023. In 3 years period, US dollar appreciated around 7.3%. In 3 years period, US 10-year Treasury bond depreciated around 9.7% price term. So from a total return perspective, that means total interest income plus foreign exchange plus bond price changes, add together, the selling program may not necessarily be loss generating. Of course, the real portfolio will be much more complicated, and it is just an illustration to show how one scenario play out with this massive reduction program. As a result of this simple deduction, we suspect the reduction program will be going on. According to the MSCI, US commercial property loans set to mature in 2023 and 2024 totally nearly 900 billion US dollar. Some of these refinancing may face challenge due to higher borrowing costs and the falling commercial property price. According to Fitch Rating, these US CMBS ratings are protected from hurricane, yet it may be affected by the higher utility costs and a sluggish China institutional buying. CMBS is a fixed income instrument that backed by mortgage on commercial properties rather than the residential real estate. They provide investment exposure to commercial real estate market, which is offer diversification benefits and higher yield than other type of bonds. Yet, we will see it may drag down the stock performance of property developers and construction material companies if their slowdown confirmed. The current yield of CMBS bond ETF is around 3.87% to 3.8%. Compare with the US Treasury yield. 1-year Treasury yield is around 5.4%, 10-year is 4.24%. Obviously, it is much more attractive to go for the risk-free rate instrument rather than the risk CMBS. So it explains why they may have difficulty in refinancing for those maturing CMBS tranches. Of course, this is the number just for your reference. We do not guarantee the accuracy of the number. We want to just illustrate our point. Extreme weather affect real business. Globally, we see a lot of flooding, all over the year. Recently in Hong Kong, they say the heaviest rainfall since 1884 in Hong Kong. We see South Korea in July, China in July, and even in Turkey, Greece, Bulgaria, Slovenia, Austria, Croatia, and even US, Northeast, and the Southwest all face unexpectedly large flooding. We also see in the South Africa, African, India subcontinent, so all over the world cannot escape this kind of extreme weather impact to local economy and even endanger people's life. And we use US property and casualty insurance sector as a proxy. We see how this largest stock market in the world, we're looking at it as a proxy for the global property and casualty insurance sector. Does this extreme weather affect the performance relative performance of this sector relative to the bond market. And we find out it is really negatively affected the performance in the 5-year period. You see this table, we have picked up 18 stocks under our coverage in the property and casualty insurance sector, and the underperformance are over 27% to 55% in the 5-year period, which is quite a substantial underperformance compared with the S&P 500 index, which is up 55% in the 5-year period. So it really hurting the sector. And we also going to see in the European stock market how the performance of the European insurance sector performing compared with the bond market. We find similar finding. Majority of the major insurer in Europe has underperformed the bond market index in a 5-year period. We picked 4 major insurers, and 3 of them underperformed by 7 to 12% during the 5 years. So we see it really hurting the insurance sector. That someone need to take extra care if you are a big investor in the insurance sector. Our take for the quarter 4 2023. There are 3 takeaways for quarter 4 2023. First one, US interest rate will remain high, and we expect a stronger US dollar against most currencies in coming quarters. Second takeaway, equity markets will be supported by the higher interest rate, yet aware of the idiosyncratic risk of certain sectors that we have mentioned, like extreme weather affected the property and casualty market, and those vulnerable sectors to the CMBS fallout, potential fallout. Third takeaway, alert to political driven policy that may affecting real business, such as the conditional ban on iPhone usage and launch of new China 5G phone that may put an impact to the mobile markets. We see no rush to increase risk asset exposure, and interest gain from cash will continue to support major stock markets. So personal assets allocation Q4 2023, for illustration, we also take a very conservative stance at this moment of time. Fixed deposit, high-grade bond will be 65%, 15% cash for bottom fishing whenever there are great drawdown, sharp correction, and if you have high conviction, you can go back into the market. And 20% is something that you invest for mid-long term, the risk asset better with some decent yield. Again, thank you so much for your time. See you next time.